On Wednesday, April 23rd, the Nasdaq 100 closed at a fresh all-time high of 26,884. The S&P 500 climbed 0.85% to 7,123, just 25 points from its own record. Iran extended its ceasefire, earnings came in strong across the board, and the Technology Select Sector SPDR fund led all 11 S&P 500 sectors with a 1.7% advance. On a day like this, beating earnings by 16% should mean one thing: your stock goes up. GE Aerospace did not get the memo. The company posted Q1 2026 revenue of $12.39 billion against a $10.71 billion estimate, a 16% beat. Adjusted EPS came in at 1.86 versus the 1.60 estimate. Orders nearly doubled, rising 87% year-over-year to $23 billion. The commercial services backlog stands at $170 billion. 4 consecutive quarters of earnings beats, and the stock fell 5%. At the same moment, its sister company GE Vernova, spun off from the same parent just 2 years ago, jumped 13%, from 991 to 1119 in a single session. The same family, the same earnings week, opposite directions. The Nasdaq was hitting records as GE Vernova soared to new highs, while GE Aerospace quietly slid. Most investors watching the tape saw a broad risk-on rally. They missed the sharper signal running underneath it.
GE Vernova reported Q1 revenue of $9.30 billion, edging past consensus, and raised full-year guidance across the board. Revenue now projected at $44.5 to $45.5 billion, free cash flow at $6.5 to $7.5 billion, up from prior guidance of $5 to $5.5 billion. The headline number was the order book. Total Q1 orders reached $18.30 billion, representing 71% organic growth. But buried inside that figure was something more specific. The electrification segment alone booked $2.4 billion in data center equipment orders in the first quarter of 2026, more than all of 2025 combined. The book-to-bill ratio hit approximately 2.5x. That is not a supply chain story. That is the AI infrastructure build-out showing up directly on GE Vernova's balance sheet. Every hyperscaler racing to build data centers needs transformers, switchgear, and grid equipment. GE Vernova makes exactly those things. CEO Scott Strazik noted the backlog grew by more than $13 billion quarter over quarter, with gas turbine slot reservations now at 100 gigawatts and a year-end target of at least 110 gigawatts. The market did not hesitate. GE Vernova is up 71% year-to-date. Now, return to GE Aerospace. The earnings were genuinely strong. The $170 billion commercial services backlog does not disappear because guidance was held flat. CEO Larry Culp was candid. If it were not for current events, we would be talking about an increase in the guide this morning. Elevated oil prices, Iran war uncertainty, and flat to low single-digit departure growth forecasts forced management to hold the line rather than raise it. Investors who expected an outright guidance raise sold the news. Here is the mechanism behind the divergence. GE Vernova's demand comes from hyperscalers with multi-year CapEx commitments. That demand is largely insulated from airline traffic, oil prices, and geopolitical sentiment. GE Aerospace's demand flows through the commercial aviation cycle, a cycle that is directly exposed to fuel costs and travel confidence, both of which are currently impaired by the Iran conflict. Same parent company, completely different demand chains. There is one condition that complicates this picture. GE Vernova's wind segment remains a drag, revenue down 23% year-over-year, with roughly $400 million in EBITDA losses expected for the full year. Power and electrification are carrying the business. If AI infrastructure investment cycles slow, or if hyperscaler CapEx commitments are pushed out, the order book that drove Wednesday's rally could look very different by the time Q2 is reported.
This divergence is not just one session of noise. It reflects a capital allocation preference that has been building across industrials for months. In prior cycles, GE Aerospace would have been the higher multiple business, long-cycle commercial aviation with sticky service revenue. That is still largely true, but the market is now pricing a premium for direct AI infrastructure exposure, rewarding companies positioned at the intersection of power generation and grid build-out with multiples that industrial companies rarely saw before 2024. GE Vernova's situation has a historical parallel from a different sector. When Salesforce and Oracle began separating in market performance around 2020, The divergence was driven by cloud migration pace. Investors eventually recognized that one had structural tailwinds the other lacked. GE Aerospace is not Oracle. Its $170 billion backlog and 4 consecutive EPS beats signal genuine operational health. But the comparison points to something real. When two similar companies diverge in multiple, the gap often widens before it closes. The case for GE Aerospace recovering leans on 2 conditions. First, the Iran situation resolves and commercial aviation demand stabilizes, specifically if WTI crude pulls back from current levels above $93 per barrel and carrier guidance firms up in Q2. Second, management issues an explicit guidance raise rather than directional language pointing toward the high end of the range. The case for GE Vernova holding its premium depends on whether hyperscaler data center capex remains intact. Amazon Q1 results are due shortly. If AWS and Google Cloud both confirm accelerating infrastructure spend, GE Vernova's order book gains credibility as a durable signal rather than a one-quarter surge. The benchmark to watch: GE Aerospace holds above 272 into next week if Iran ceasefire progress is sustained, or breaks lower if oil prices remain above 90. GE Vernova holds above 1100 if the next round of hyperscaler earnings confirms capex acceleration, or gives back the gain if any major cloud provider signals a pause. Both companies are run well, but the market on Wednesday made a precise judgment about which demand curve matters more right now. Whether that judgment proves correct depends on 2 timelines, one geopolitical, one technological, that have no clear resolution date.